Good afternoon, ladies and gentlemen. Welcome to the Washington Institute. We are, I believe, being webcast on the Washington Institute website, and we're also being recorded for C-SPAN, which may or may not be live. And if I could introduce myself, I am Simon Henderson, the Baker Fellow and the Director of the Gulf and Energy Policy Program here at the Washington Institute, and also, for the purposes of today's occasion, the co-author of this report, Energizing Policy, which I've written with my colleague, Dr. Patrick Clawson, who's the Director of Research here at the Washington Institute. And I'm very pleased that we're able to welcome today Dr. Helima Croft of RBC Commodity Markets, Capital Markets. Capital Markets. Dr. Croft is a New York and Boston based expert on many things, but for these purposes of today, it's her oil knowledge that we're particularly grateful for her being here. I'm going to start off by asking Patrick to talk about the project and outline its the background and what we looked at and some of its contents before I then turn to Helima to comment on it. Later on, after I've finished engaging them both in discussion, I'll open it up to questions. So, Patrick, Dr. Clawson.
Thank you. So we here at the Washington Institute are really interested in U.S. Middle East policy. We are not particularly experts on where energy markets are headed, and I will leave to Dr. Croft to comment about those matters. I would just simply say that U.S. policymakers have been surprised by how energy markets have turned out on numerous occasions in recent decades. And I would indeed, without wanting to step on Dr. Croft and her colleagues' toes, suggest that perhaps some people in the energy business have also been surprised at the directions in which the energy business has evolved. But we started this project a few years ago when it certainly seemed that rising U.S. oil production was going to substantially cut into U.S. oil exports, and the United States was going to become much more self-reliant on its own oil production. We then suspended the project for a while after the oil price declines of a few years ago to see how the turmoil in the markets sorted itself out. And I think that we were as intrigued as many people in the industry to discover how quickly the U.S. oil producers in the shale oil and the tight oil adapted to the new conditions, and how relatively robust U.S. production has stayed. And I personally have been impressed at the rate in which technological progress and generally adaptation to the new market conditions have allowed U.S. producers to maintain quite robust production. So I'm quite the optimist about U.S. oil production. But the main impetus for our project initially, and as we started, is that so much of the story that we were hearing from foreign policy experts about rising U.S. oil output and combined with the stagnant U.S. oil demand that was leading to the United States to become more self-reliant in oil, the general story among foreign policy experts was that this meant that the United States was going to draw down its presence in the Middle East, and many people talked about a potential withdrawal from the Middle East. And indeed, we find such politicians as President Obama saying in his interview in The Atlantic this spring that the United States can be less involved in the Middle East because of the rising U.S. oil production. And we wondered if that was the basic lesson that should be taken from these developments. And not just because we're in the business of promoting an active U.S. policy in the Middle East, and therefore that would be bad for our line of work. But more generally, we thought that it would be worth looking at the questions about what effect these developments were having on the Middle East. And what we found very quickly when we started talking to people in the foreign policy field and in the energy field is that this concern about U.S. withdrawal was really looking at a small part of what is a much larger picture. And that, in fact, this development of greater U.S. oil production was good for the United States and good for U.S. policy in the Middle East. That there's a reason that the last 8 presidents of the United States have talked about reducing U.S. reliance on imported energy. And that is that with the United States more self-reliant, that strengthens the United States in U.S. interests in a variety of areas, including in the Middle East. And let me therefore start with the advantages for the United States of this development. Most obvious is that it reduces the United States' vulnerability to oil price hikes. And it reduces the United States' vulnerability, in particular, to oil boycotts. I mean, after all, that shocking experience of 1973, when we found many major oil producers refusing to sell oil to the United States, caused a real scramble. And that just simply would not be possible under some of these scenarios in which the United States becomes fully self-reliant on oil. But more generally, the more the United States is self-reliant on oil, the harder the United States can push Middle East oil producers without being concerned about their reaction. So there's just a whole variety of issues on which the United States has tread on eggshells in dealing with Middle East oil producers, where, frankly, we can push hard. And I particularly study Iran, and I can remember showing my age here, the days almost 20 years ago when the United States started pushing hard about the Iranian nuclear program at the same time that the United States was pressing Mr. Gaddafi, remember him, in Libya about his activities supporting terrorism and pursuing chemical weapons in particular. And the United States had placed significant sanctions on Iraq, which had, after all, been a major oil producer. So there were 3 major oil producers, Iraq, Iran, and Libya, which at the same time the United States was pressing. And that was really only possible because of the ample market conditions of the time, 20 years ago. And that was very clear in U.S. policy discussions at every level, national security officers, with Congress, you name it, that it was the ample market conditions, the ample supply of oil, in other words, which made it possible for the United States to simultaneously pursue its objectives with all 3 of those producers. And had market conditions been tighter, the United States would not have done that. And indeed, we saw that when market conditions became tight, that the United States became very concerned about the reactions of oil-producing countries, including some of our good friends like Saudi Arabia. And so when Saudi leaders expressed concern about U.S. policy in certain areas, Washington got very nervous. Official Washington got very nervous. And the extent to which the United States has to be less concerned about the reactions of oil producers in the region means that the United States can press harder about countering weapons of mass destruction. The United States can press harder about counterterrorism. There are a number of oil-producing governments in the region which have a good declaratory stance about not having their citizens contribute to terrorist groups, but don't necessarily do very much about this. Our Kuwaiti friends have been most reticent to actually take practical steps to put into effect the nice-sounding laws which they have on their books. And we can press harder on them. We can press harder on the Saudis about inflammatory content of some of their teachings, such as make it clear, I'm not suggesting that the Saudi government in any way supports these terrorist groups, but I do think there is some inflammatory content in some of their educational and other materials. And we can also press these governments in the region to engage in the kind of reforms which we think are necessary for their long-term stability, such as issues about democracy and human rights and open markets, which they have not always agreed with us are really their priority. And we have had to be reluctant to do, we've been reluctant to do very much at times when oil markets were tight. So the ample oil supply conditions and the high U.S. oil production work hand in hand to empower the United States in dealing with this in this region, and that's a good thing. Now, to be sure, there are some disadvantages, and in particular, as the United States produces more oil, then the suspicion is going to rise in the region that we're going to withdraw from the area. Right? 26 years ago tonight, when Saddam Hussein invaded Kuwait, the United States became much more involved militarily in this region, and that was a big shift from where we had been previously, where our presence had really been rather minor. And over the last 26 years, this area has been the theater in which most U.S. military operations have taken place. And they've had a checkered record. Some of them have been smashing successes, such as the liberation of Kuwait, and some have, shall we say, not. But they have been an important part of bringing stability to the region. And certainly many in the region have come to depend upon the United States, depend upon the United States' presence over the horizon, if not the actual U.S. involvement at the moment, as an important guarantor of security and an important guarantor against external aggression in particular. And if countries in the region perceive that, get worried that the United States is going to be pulling back, they may do things which we don't approve of in order to try to improve their security situation. Of course, the nightmare is that they decide to develop, our friends, decide to develop weapons of mass destruction in order to have their own independent deterrent. But even short of that, we don't want to see these countries in the region deciding that they need to take independent actions that don't take into account of Washington's concerns. It's also, frankly, going to be difficult to generate domestic political support for our involvement in the Middle East if there's the perception that U.S. oil production is satisfying our own energy needs. After Saddam's invasion of Kuwait 26 years ago, then Chairman of the Federal Reserve Board, Alan Greenspan, stated in a book that the Iraq War is all about oil. Well, not quite all about oil. I think he had different phrasing, but you get the idea. It's basically about oil. And that was wrong then, and it's wrong now. The principal reason that the United States has been involved in the Middle East security matters has been because the Middle East excels at producing insecurity, and that the insecurity does not stay in the Middle East. And I find it striking the extent to which memories of the September 11th attacks seem to have faded, and people forget what happens the last time that we decided that we can turn our back on the security situation in a country where we had been strongly involved, namely in Afghanistan. Then that the extremists did not stay in Afghanistan, and I would say that if we take a look at the extremists in the Middle East, they would not stay in the Middle East. And so that the principal reason that we are involved in the Middle East is because of the insecurity that comes from the region. And that point needs to be made repeatedly to the American public. I mean, we at this institute have on several occasions organized events for the advisors to an incoming U.S. president, and a constant theme since I was first involved in those 6 presidents ago, was that, sir, you may not wish to be involved in the Middle East, but the Middle East will be involved with you. And that you therefore may decide to ignore the Middle East, but if you do, it will be at your peril because the Middle East will come back and bite you. And I would say that a number of those presidents, in fact, campaigned on promises that they would reduce the United States' role in the Middle East. And we tend to forget, for instance, that George W. Bush ridiculed the Clinton team for the time and effort that the president spent on Middle East peace, and insisted that his administration would return to putting the great powers as their primary concern and not the Middle East. And that in the early days of the incoming Bush administration, those who wanted to see an active role in confronting Saddam Hussein lost the internal battle and were told no. And really, it's only after September 11th that things change. So that's going to be a real problem, is how we explain to the American people that we should get involved. Another problem that we raise, which not as important, is that the low oil prices, which are likely to accompany, and the low oil sales by the Gulf oil producers, which are likely to accompany a robust U.S. oil production, has the potential to destabilize friendly oil-producing countries if they don't take the necessary reforms. In other words, they don't listen to our advice about taking reforms and try and keep on with their old ways of doing things, though that old way will not work, and at some point it could crash and burn, and that would be put at risk, those regimes. So anyway, we provide a number of suggestions, which we think are rather practical, for ways to maximize the opportunities and minimize the disadvantages from higher U.S. oil production. And the basic theme is that Americans need to hear about why the U.S. is involved in the Middle East. It's not oil, it's insecurity. And the Middle East needs to hear about how substantial is the U.S. commitment to the region. We have tens of thousands of troops that we plan to have there for the indefinite future. And we have shown repeatedly a willingness to bring in more forces when needed. And the world needs to hear that the United States can walk and chew gum at the same time, that active U.S. involvement in the Middle East does not come at the price of an active U.S. involvement either in East Asia or in East Europe, and that the United States can do all of these at the same time. And we also provide a number of suggestions about ways in which the United States should listen to U.S. friends who are, we should think about how our words sound to them so that we can be more certain that the message is getting across, that in fact we are there ready to defend them if necessary. I know Mr. Trump has talked about how if NATO countries want to see the United States making defense, then they have to make more of a contribution to this themselves. And as he was saying that, I was thinking about our friends in the Middle East, most of which spend a multiple of what we do as a percent of their GDP on their defense systems. And if we're going to apply that as our, this Trump metric of whose merit, who deserves a U.S. role in helping with their security, the Middle East is going to be top of the list. So with that, let me turn the microphone over to Dr. Croft, and I'm going to be fascinated to hear what she has to say. And
One moment on that one. You can do what you like. But I'm the one in charge of the microphone. And I wanted to take the opportunity once again to say that we're here for this meeting for the benefit of those who are not physically here to review this work by Patrick and myself on energizing policy, America and the Middle East in an era of plentiful oil. This is a hard copy version of it, but you'll be pleased to know it's available on our website, both in a form that you can read on the website and in a form that you can print off on the website. It's some technical reason, it's slightly different. And the website is Washington Institute as one word .org. But I will now turn the microphone over to Dr. Croft. And we think and we write, you actually earn a living. What's your perspective on this question?
I love this question. I love the report, actually, because I actually started my career after getting my PhD in the U.S. government as an analyst covering Nigeria. And so it was very interesting to me to read this report because it reminded me a lot of what I saw go on in 2003 with the Nigerian elections, because that was a time when the U.S. government was very focused on non-Middle Eastern sources of supply. We were very excited about Gulf of Guinea. We thought Nigeria would go to 4 million barrels of production by 2010. And we had a relationship with that government where we wanted to be, I would argue, very helpful to them. Now, if they were not a resource-rich country, would we have wanted to be leaning in so much with that government? Probably not. But I remember my sort of formative experience as a young analyst when we had a very questionable 2003 election. And the sort of pressure we felt as analysts to not be so critical of the Nigerian government, to basically say, well, even though it might have been rigged, would the opposition really have won anyway? And we then, President Bush went to Nigeria. And for people in Nigeria coming after that election, they literally said, look, we know you know that election was rigged, and you don't care because you care about the oil. Now, we also had an important strategic security cooperation with Nigeria. They were seen as an anchor state for West Africa. But was oil a critical part of that sort of trade we did with that country? I think a lot of us felt underlying that bargain was the need for the oil. And then when I was on a task force at another think tank, which I won't talk about now, 2006, we did a report on energy and national security, and I was one of the more junior members of that task force. And what was so interesting was that first there was a view, which we talked in the report, that the U.S. would never be able to drill their way out of dependence on foreign oil. So what we had to do, instead of trying to increase U.S. production, was manage our relationship with these producing countries. And within that task force, those deliberations, there were real fights that emerged between people who said, with lots of experience, we should be pushing countries like Russia much harder. We should be pushing countries like Saudi Arabia much harder on reform. And others who said, are you kidding? We're never going to drill our way out of dependence. We have to basically have more of a transactional relationship with these governments and stop badgering Russia about these issues. Stop badgering Saudi Arabia about women, about the textbooks. Come on. What is the importance of our relationship? And so it was very interesting now to think about how this U.S. energy revolution has sort of changed those dynamics. All I can tell you is when I look at a country like Nigeria and I look at what happened in the 2015 elections and the fact that the U.S. government, the UK government, the UN essentially said to a sitting head of state, we know you've rigged this election. We know that basically you're intending to try to stay in office. If you do that, we're going to raise the consequences for you in terms of travel bans. We're going to make it very difficult, asset freezes. We would like you to leave. I was talking to one of my former colleagues, and I said I could not have imagined this would have been the case in 2003. We did everything to basically keep that administration in the seat, whereas now we were saying we care about the election, we care about human rights, we care about governance issues, and it's time for you to go. And again, I think that really is a factor of the American energy revolution. And particularly for a country like Nigeria, those were the barrels that were displaced by North American production. It's the light, sweet barrels. We used to take 10% of our imports from Nigeria when I covered the country in 2003. Now we take very little imports. Those are the barrels that have been displaced. In fact, those are the countries I think that have been hit hardest because they not only get hit by a price impact, they get hit by loss of market access. And now everybody has to sort of scramble to access the Chinese and Indian market, and it's a crowded party. So those are not just Middle East, but there are some other real net losers. But, that's the benefit. You can have, again, I would have loved to have been that analyst who believed in certain values to be able to take a tougher line on that government. But in terms of drawbacks from where I sit in the markets, the biggest thing we're concerned about is, A, what are the economic dislocations caused by this type of price decline? I mean, you had governments that essentially ran up their spending post-Arab Spring and are now facing very significant deficits in this price environment. Now, for the wealthy GCC countries, they have ample sovereign funds And, they have substantial safety nets and shock absorbers to deal with lower for longer. But they're having to deal with it through renewed debt issuance. So if you look at this year, it's been a blockbuster year for GCC sovereign debt issuance. It's like $34 billion. Saudi's expected an additional $15 billion. Again, they can borrow. But at a certain point, it's going to become a question of how much borrowing do you want to do? What does refinancing look like in a couple years if we're in this muted price environment? What can you do in terms of structural reforms to lessen your debt load? How much do you want to draw down your FX reserves? So these governments are going to have to be making choices. There's also a little bit of skittishness, I can tell you, with the whole issue of if we don't get a recovery, will some of these sovereign flusher producers, are they going to have to sort of pull back in terms of their sovereign wealth fund investments? So it becomes questions about, are they going to be making the same type of investments in real estate, in European equity markets? So those are things that people start to think about and get a little concerned about, even with the sort of richer countries. But for, obviously, the poorer producers, this is a catastrophe, this price environment. I look at a country like Iraq, and I say they've been hit every which way between ISIS, low oil price environment, the political problems in Baghdad. And so for them, they basically have, very little options but to take on, borrowing from the IMF in order to try to meet their payroll. And from a markets perspective, everyone is so excited about the North American energy revolution, but they can't provide all the barrels needed if nobody else is growing. And if you look at sort of global decline rates, for the next couple of years, we do have large inventories. But if we don't have other sources of supply come on the market in the next 3 to 4 years, then the market does tighten. And the country I'm most concerned about, frankly, is Iraq, because Iraq was supposed to be 40% of new supply coming on the market over the coming decade. It was supposed to grow from about 4.5 million barrels now to 8.5 by 2035. Iraq is truly the low-cost producer. And so the question is, if that government doesn't have the money to make the investments in their energy infrastructure, and international oil companies themselves are facing tremendous cash cuts themselves. If you look at hundreds of billions of dollars in foregone investment, they're not willing to deploy as much capital to places like Iraq. And so what you could really see is a combination of this low price environment, other security issues, is Iraq materially underperforms in terms of expectations of future growth. And I look at sort of globally, the only countries that are continuing to put rigs to work on a significant scale are the GCC countries. Iraq's rig rate has halved in the last 2 years. Venezuela, Nigeria, these countries have all seen dramatic reductions in their rig rates. We've had shelvings of deep water projects. And so to me, going forward, I'm concerned about also how does the market remain supplied over the medium term if North America is the only place that is growing. So again, I think there is resiliency of U.S. production. I think beyond just the technological innovations and the dynamism of these companies, it's the fact that U.S. capital markets remained open to these companies. They didn't have the bankruptcies that were expected. But again, if capital markets remain open, if all these conditions remain in place, I still think we're going to need those other producers to come on. And I think that is something that we're not really thinking enough about. Again, what if the other producers simply can't grow their production in this price environment?
Thank you very much. Let me just come back to you on this. Could you explain to us how far ahead you look? And also, and remember, most of the audience is essentially a lay audience. There is all sorts of talk that oil is going to be a declining fuel. It will be replaced by something.
Renewables, yes.
What is it going to be replaced by, and what is a reasonable time horizon? Is it our lifetime, our children's lifetime, our grandchildren's lifetime?
Yeah, I mean, I certainly don't think for the next decade, I think we're still going to be talking about dependence on traditional fossil fuels. I think that when you get to sort of long-range planning departments for national oil companies, they're the ones that are getting increasingly concerned about renewables, not just, the efforts being taken in Western governments. They're actually very focused on what if China is actually serious about environmental related illnesses. What if, battery-powered cars become cheap and basically mass market? So the national oil companies in the Middle East, long-range planning, are worried about that. I don't think that we're thinking of it the sort of 3 to 5 year horizon, but I think that for the oil price situation, this is what becomes very interesting, because for now we have very large global inventories, 5-year highs. So even if we have a disruption, because we're not that oversupplied anymore in terms of how many more barrels on a daily basis are not finding a home. We've really compressed that this year. The biggest issue that's choking the oil market and keeping the prices in this sort of low 50s environment is we have very large global stockpiles. Over the next year, we think those will be worked down, but we don't think we're going to get to 65 because of those stockpiles. Once those stockpiles, though, are drawn down, then I think it becomes a question of how much U.S. production can come back, but also, again, the issue of U.S. production plus what other barrels. And I think that's why people are more concerned about sort of 2, 3, 4 years out, where things could be getting a little bit trickier in terms of the oil market, and that U.S. production, even if it comes back, won't be enough necessarily to prevent prices going to sort of 70, 75. Maybe 100's off for now, but again, if you have something that happens in Patrick's universe, that can still be back on the table. I mean, I think right now geopolitics, there's very little geopolitical risk premium in the market, but things can always change.
Patrick, could you explain a little how we approach the unknown out there? And essentially, we chose 2 different visions of the future. And we rather hoped it would either be one or other or somewhere in between. It could, of course, awkwardly be outside those limits, but for our purposes, you had to draw some lines somewhere.
Well, it was truly humbling to take a look at some analysis which we've done of past forecasts. And what we discovered is that repeatedly over the last 20 years, when noted experts, the International Energy Agency or the U.S. government's Energy Information Administration or companies like BP or international agencies like IMF had done forecasts of where they expected to be even 5 years out, much less 10 years out, that repeatedly that when they presented a range of forecasts, the actual outcomes were outside of the range. I did some work for one U.S. government agency which estimated that the most energy forecasts turned out to be outside the range of what the energy experts had said was the wildest possible range, right? We said, oops. And so it's interesting that lots of these agencies and companies are now presenting much wider range of estimates. And by the way, it's not just U.S. production, which is an unknown variable. There's lots of disagreements about where demand is going. Where demand is going in not only in the industrialized world, but in the industrializing world. And so when you put this all together, what seemed to be sort of a consensus, as I say in the past has been wrong, but that would seem to be a consensus, is that the plausible alternatives range from one in which the United States continues to import about a third of its oil. Mm-hmm. And by the way, I should comment that we found it most useful to look at oil in its broadest sense. That crude oil is only one part of oil and is increasingly a smaller and smaller part of U.S. production. And so we're looking at everything from biofuels to natural gas liquids to crude oil. So there's one scenario would be in which the United States continues to import for the indefinite future about a third of its oil. And yet there's another scenario which seems to be quite plausible, in which the United States becomes a very significant oil exporter. And I don't just mean the U.S. exports some oil and imports other. I mean the United States is a net oil exporter on the order of several million barrels a day. So that's a pretty broad range. Right? But we said that that U.S. policymakers, when they're thinking about where U.S. policy should be going over the next 15, 20 years, ought to have a set of policies which are sufficiently robust that they make sense in either one of those two kinds of circumstances. Because they may not know until we get relatively close to the day which of those two circumstances comes to pass. And that if you look in here at some of these charts which show just how quickly the U.S. oil production ramped up, things could change that quickly again. And so we should have a set of policies which are robust enough to handle either of those two situations. And by the way, in the oil industry, they say that the cure for low oil prices is low oil prices, and the cure for high oil prices is high oil prices. In other words, if the prices stay low long enough, then people don't invest. And then the prices overshoot and go high. If the prices stay high long enough, they overinvest and the prices come down. Yeah, that's true. But many of the people that we spoke to and many of the forecasts that we looked at thought that actually the character of technological advancement probably matters as much as price, and that there are an awful lot of what has happened to the oil industry or the energy industry in the last decade has been driven by unexpected technological advances. And that if you go back a decade ago, or a little bit more now, the general feeling was that the technological advances that we were going to see would be ones that would make it possible to produce from oil sources not yet available, from deep water, offshore, and oil, and that major oil companies, international oil companies, would be the ones spearheading this development. Well, what's happened since then is we've seen some very major projects that have not done well. I mean, when you look at the record of the $170 billion spent on natural gas in Australia, it's daunting. I mean, we have one project alone with a $17 billion overrun, and is years late. And that's nothing compared to the Kashgan project in Kazakhstan, which is now $30 billion over budget, which produced for 1 month in 2003, actually less, in 2013 before it had to shut down because it wasn't working, and which now, after a $17 billion fix, may come online this fall. So the technological advances we expected 10 years ago turned out not to happen, and ones which we did not expect, especially in the production of shale oil, but also, frankly, in the dramatic improvements in efficiencies in U.S. automobiles, have taken place.
Helima, one of your professional responsibilities is to monitor OPEC, and the joy or otherwise of this is going to OPEC meetings. How is OPEC responding to this, and how do you split up OPEC in their responses, and are we heading towards the end of OPEC or a new OPEC?
Well, I always talk about the sort of summer enthusiasm and then sort of the winter of discontent at OPEC, because last spring, we forget. I mean, if we think about sort of May 2015, we were looking like we were headed, back to a recovery in oil prices. I mean, we were in the 60s. And I remember going to that June meeting, and Ali Naimi, it was the seminar before the meeting, so it was a much bigger meeting, and then they had the seminar and then the meeting. I mean, Ali Naimi jumped on stage, took the microphone like you just did, and essentially said, the future looks bright for oil. we're in the midst of a demand-driven recovery. And speaker after speaker talked about 70 by year end. They thought they had done enough damage to shale oil. They thought that, the demand picture was elastic. And if you look at demand last year, it wasn't the problem. And demand was at a 5-year high last year. Cheap oil, certain countries will back up the truck and fill their SPRs, or strategic petroleum reserves, in that price environment. So everyone was very optimistic, from particularly the richer countries. But I remember there was a poor OPEC panel, which was sort of Venezuela, Angola, Ecuador, Nigeria, and Iraq. And they were all asked, what's the fair price for oil? And they all had to say 70. And they looked like they had sucked on a lemon. So I wondered if they were told by the rich GCC countries to say 70 was the price they were aiming for. But, I was thinking, God, 70 doesn't work for some of these countries. But still there was this consensus that we turned the corner. Then you get to the December meeting, and the mood is just soured. I don't think the press covered just how disruptive that meeting was. You had a situation where the Venezuelan OPEC representative was pointing at, the Qataris, saying look, if we don't take action, we'll see the 20s. And, the GCC countries were sort of dismissing that, but everyone walked out sort of grim-faced. I remember in the press conference, al-Badri, the OPEC Secretary General, we were looking at the document saying there's no collective price ceiling anymore. It was 32 million. Where's the ceiling? And he was like, we couldn't agree. We couldn't agree, so we're all just going to produce. So you saw that sort of dysfunctionality in OPEC. You fast forward to this June meeting, and again, I think it was a little bit like last summer, a rerun, where we had the recovery to 50. Everybody was saying we turned the corner in terms of prices. We are on an upswing, that we need higher prices to incentivize investment in the energy sector globally. And no one wanted to give out the sort of price target, but people were talking about moving eventually into the 70s. And so we're now back at getting a bit of a reversal because of this sort of gasoline glut that we're seeing, new concerns about demand from China. And so I'm wondering what the December meeting will look like if we are not once again on that path to recovery. But we have tremendous disparities within OPEC between GCC, and I call them in our published research the fragile five. A Libya, an Iraq, a Nigeria, a Venezuela, even Algeria. They're facing such a difficult price situation in terms of their deficits, their inability to fund essential services. And so I think that's the tension between countries that can ride out the storm and these poor producers who are basically saying, you have to come to our aid, and sort of appealing to the richer GCC members who are essentially saying, we're okay for now. And I think that tension will only increase if we don't get that recovery that was anticipated this spring. So I'm not sure I'm going to see OPEC splitting up. Everyone was so excited about the election of the new Secretary General that they could come together and do something. But I think that these tensions, as long as we stay in this muted price environment, the tensions are going to be there. And it's really a bus OPEC that's driven by Saudi Arabia and the other GCC countries. And the poor OPEC countries, they're just passengers at this point.
And the Saudi oil policy, to the extent it's comprehensible, understandable, is to retain market share.
Yes, and it's a brutal battle for market share. In terms of, the return of Iranian barrels do nothing to make this situation better. Again, as I talked about earlier, what happens when you have U.S. production and you don't need as many barrels coming into this country, what it causes is a brutal battle to access the Chinese market, to access the luckily for oil producers, the expanding Indian market. But you see aggressive efforts to undercut in terms of prices, to place your barrels there. We have, on any given month, Saudi Arabia is topped by, Russia as the biggest supplier into China. We've had months in India where Nigeria has come in as the number one supplier into the Indian market. It's not the perfect barrel for Indian refineries, but if you are willing to discount your barrels to such an extent, you will get a home. And even if you think about the policies China's pursued with some of their client states, when they do more loans to Venezuela, the way those loans are repaid is through barrels. So they get locked in market access. Brazil gets locked in market access to China when they get lending facilities from China. So it makes the battle for the remaining market that much more intense. And I think that's a key driver of disunity. But I'm not going to call it a death spiral, but it's a very, very difficult outlook for these producers going forward, given the fact that they're pushing barrels into smaller number of countries. And European demand they're not a driver of demand growth. It really is China and increasingly India are the two biggest markets. And it's a crowded party.
So, Patrick, we're in a increasingly ironic situation that, and the experts have always said the dependence of the United States on Middle East oil has always been exaggerated, and these days it's even more exaggerated. So, to what extent do you think the U.S. should share its responsibilities for a leadership role in the economics or the politics or the geopolitics of the Middle East with other countries? And India and China have been mentioned as great markets for Middle East oil. Shouldn't we be working together, sharing the responsibilities?
Well, one set of responsibilities is the international agreements among the advanced industrial countries to maintain strategic petroleum reserves. And there has been discussion about involving India and China in that. At the moment, the charter of the International Energy Agency makes it open only to OECD members, but there's been a proposal to open it up to India and China. Well, interestingly enough, the Chinese, in response to low oil prices, have been constructing a very large strategic petroleum reserve of their own. It's now the second largest in the world, after that of the United States. And so for their own independent reasons, they've decided to have a large reserve. Personally, I think that there'd be much merit in resurrecting the idea of bringing them into the IEA. And indeed, conceivably, what we ought to do is strengthen and expand the role of the Saudi-based organization called the International Energy Forum, which is a small organization that brings together both the consuming and producing countries. I think the Chinese would find that a more acceptable mechanism to cooperate internationally rather than in the International Energy Agency that's so dominated by the advanced industrial countries that China is suspicious about. So that's one set of issues about the Strategic Petroleum Reserve, and there are some other, associated initiatives. There's been, for instance, a data initiative called JODI, Joint Oil Data Initiative, right? Which is trying to improve the transparency of production, consumption, and reserve numbers, and the cooperation with the Russians and the Chinese, and that has been so-so. But it's worth persevering in the efforts to make JODI work better. God knows the situation's dramatically better than it was 5 or 10 years ago when we had no clue what was happening in those countries on the consumption or the demand side. But then another whole major set of joint responsibilities is the protecting the sea lanes of communication, or SLOCs. And the activities of the Chinese in the South China Seas and should give us pause to any notion that we should be encouraging China to play a more active role in protecting sea lanes of communications. Shall we say that the Chinese view about the high seas rather differs from that of the United States and of the major maritime powers, whose attitude has long been that we should have the water should be open to everybody. And that's not been the focus of the Chinese, who have this sort of attitude, well, it's exclusive economic zone be damned. If it's ours, it's ours. And I don't think that we want to encourage that. And so I would certainly accept that it's a little odd that the United States Navy is protecting the sea lanes of communications that are vital to Chinese industry. But I'd rather have the U.S. Navy protecting it rather than having the Chinese do it. Thank you.
I will be opening it up to questions in a few minutes, but so get yourselves ready, and there will be a microphone which will come around in due course. But one more question first to Helima Croft. When I looked at the price of oil this morning, it had, I think, dropped a bit. There was a chance that West Texas Intermediate might fall below 40, which means something to the market. I'm not quite sure whether it means much to the rest of us. What sort of political event would actually cause the oil price to zoom upwards, spike upwards? There used to be a point then, bad news in the Middle East, the price of oil went boop.
It's so discounted now.
But that no longer applies. This morning's Wall Street Journal has on the front cover a picture of a bloodied Kurdish fighter at an Iraqi oil field where he had apparently successfully countered an ISIS attack on the oil field. And last week, the head of the Iranian Revolutionary Guard made a threat to close the Strait of Hormuz. But the market shrugged it off.
All shrugged it off.
And so, what should we be scared of?
I mean, I think from a market perspective, this is where, again, the ample U.S., production that we've seen, but also the global inventories being at a 5-year high. People might say, well, supply and demand now looks like it's coming into balance because we've had some disruptions. I mean, Nigerian production is now down, by some accounts, 600,000 or 700,000 barrels because we've had a return to militancy. We had the Canadian fires over the summer. But people say, you know what? Global inventories are 5-year highs. We can sustain lots of disruptive events. So things that might be, bad from a security perspective in the Middle East, if no oil looks like it's at risk on significant scale, just written off. And in terms of Iraq, you're right. I mean, there was an attack in northern Iraq. Market shrugged it off. Now, if you had ISIS show up at West Qarna 1 down in the south and detonate something outside a facility, I think the market might pay attention. Though we had ISIS attacks on Libyan energy infrastructure, market seemingly wrote that off. So I think you'd need to see something dramatic. I think it would need to be, almost, I hate to say this, like Abcake take two, in terms of also something potentially in Saudi Arabia. The market would pay attention.
To tell them briefly what Abcake case
yes,
one is.
the near miss that was on, when you've written on this, the world's largest oil processing facility in 2006.
So.
And so if we had something significant in Saudi Arabia, the market wouldn't shrug that off. But again, I look at the fact that I have Nigerian production down by 600,000 to 700,000 barrels, which has brought us basically into market balance. Venezuelan production looks like it's now in almost a structural decline because of lack of investment. So Venezuela will be down several 100,000 barrels year on year. Oil service companies are pulling out because of non-payment. So I look at this situation and say we have a whole host of producers that are very challenged, and yet it's had not a huge price impact. So I think in terms of some event, we would need something at this stage quite dramatic to get the market excited.
2 seconds then. So I participate periodically in exercises by the Department of Energy's Strategic Petroleum Reserve about these sizing exercises. How large a Strategic Petroleum Reserve do we need? And this spring, when we have discussing this, it's really kind of hard these days to come up with a scenario that's going to require the use of the Strategic Petroleum Reserve, except for significant instability in Saudi Arabia. And so it really is Simon's expertise about who's going to be the next king of Saudi Arabia and how the royal family is doing that determines how large a strategic petroleum reserve we need. And if you want to ask Simon, what would it take to really cause an oil price spike, it would be if things go haywire in the field you study most so closely, namely Saudi royal family politics.
Well,
do you have a word on that, Simon?
Is that a question? My initial response to that would be that, curiously, much of the uncertainty in Saudi Arabia at the moment is to do with leadership and to do with the Islamic State. And to that extent, it doesn't impact on oil. The ingredient which impacts on oil is what happens in the eastern province of Saudi Arabia, which is where pretty well all the oil reserves are and the most important oil installations are. And these are vulnerable. I mean, they are defended and protected, but they're essentially still very vulnerable to attack or sabotage. And there are two ingredients there. One is what the local Shiites of the eastern province, where there are a local majority, do, with or without the instigation of their co-religionists in Iran, and also whether the Islamic State, in its attacks on in the kingdom, choose oil targets. And as you mentioned a few minutes ago, there are Saudi Arabia's got a lot of oil, but there are and the infrastructure is stretched over many hundreds of miles, but there are occasional bits which are concentrated. And there was one particular place, as you mentioned, Abqaiq, which sounds like some sort of cookie, but is in fact spelled Abqaiq. It's where it's a processing plant for the oil. It's sort of the first sort of clean and of the crude before it gets shipped out. And most of Saudi's oil production goes through one place. And if you can hit that place, then this could really impact on Saudi oil exports very quickly. And the last time in 2006, this doesn't look good unless somebody moves. Anyway, the last time this Abqaiq was attacked in 2006, it would have been substantially damaged if the chap who was driving the truck with the explosive on it had made a better calculation of where he needed to press the button to destroy the installation as he sped along underneath it. He failed to destroy the installation. He succeeded in killing himself. Anyway, that in brief is the Saudi story. But we are now open to questions. And again, for purposes of our webcast and our C-SPAN, we are here talking about this publication, which is written by myself, Simon Henderson, and my colleague on my right, Patrick Clawson. And it is Energizing Policy, America and the Middle East in an Era of Plentiful Oil. And we're joined today by Dr. Helima Croft of RBC Capital Markets, who's a very great experience on oil, OPEC, and many other things. So questions, and there was one in the middle here, and then and then one over here, and then I'll come to the other ones if I can remember whose fingers I spotted first.
Hi, Greg Rose, formerly at the Defense Department. Those of us that came of age on the issue of oil in the Middle East in the 70s and before remember how, from a geopolitical standpoint, as Patrick has pointed out, this was a critical region. Basically, the case was made that if you cut off oil coming through the Straits of Hormuz, it would cause a global recession or worse, if it was a big enough cutoff, which the oil price spikes reflect, right? Because that's what it could mean for the global economy. So my question is that, how dependent today, not in the future, today is Japan on oil that comes through the from the Middle East broadly? How dependent is Europe on it? if it were cut off for an extended period, I know it might not be possible because of military reasons, but if it were cut off for an extended period, what impact would that have on the global economy? Would it cause a recession today? And then the last question, Europe has not embraced as much as the U.S. has the new technologies of fracking and other oil extraction. What is the potential in Europe, and how, can you give us a sense, and this is really, Helima, to you, how much has Europe been getting its, from my perspective, act together on that?
A couple of comments. One is that the world economy has gotten more used to price spikes in a variety of commodities over the last 40 years. And the great moderation was the phrase that economists used to describe the previous period, and we're not in that any longer. And so the effects of price spikes are no longer as shocking to people as they once were, and we adjust to them much more. And an interesting aspect of the U.S. tight oil revolution is that there are an awful lot of producers who can expand their output quite quickly. Not in a matter of weeks, but certainly in a matter of less than a few years. That there could be a dramatic increase in U.S. oil output if the prices went up to $100, $120 a barrel. We'd see, most estimates are that we would see an extra 2 million barrels a day before very long. And the world has got a lot more strategic petroleum reserves than it used to. And the Gulf states have done a lot more to develop ways in which they can bring oil out of the Gulf without going through the Strait. So the Strait is much less of a choke point than it once was. But certainly it is the case that if there were to be, and also blocking the Strait for a prolonged period of time is no easy task. It's one thing to block it for a few days. It's another thing to try and block it even for some months. My friends at the Energy Department are not happy by the extent to which the blocking the Strait scenario is no longer an easy way to defend the SPRO. Right? Yes, there would be some real disruptions, but nothing like what it once was. And also, by the way, a lot of what would happen in the U.S. economy is that those of us who live on the East Coast and West Coast would have to pay a lot more oil, and the good citizens of North Dakota would be sitting pretty, although for that matter, so would the citizens of Pennsylvania, because so much oil is produced there.
Helima.
In terms of the shale revolution, I mean, as you know, it's basically been thus far really a U.S. revolution. I mean, people have talked about shale development in China, but there are water issues and infrastructure issues with it. It has not panned out particularly well. People were very optimistic about Poland. It has not panned out for a variety of reasons. Some of it geology in terms of Poland. France has been a very interesting case because apparently one of the most prolific basins is under Paris, and after Gasland, the French were not very eager to develop that resource. People were looking at sort of southern England as well, but again, it just seems to me right now, something that is uniquely American. And people, when they look at Latin America, look at, the basin that is basically right over the border from Texas into Mexico, and how to develop that. But of course, one of the things that's really facilitated the U.S. development is the private land ownership. Not necessarily the case when you get down into Latin America. Also, crime issues around that part of Mexico. Other one, Argentina. People were very optimistic about Argentina, but the problem was, again, it wasn't a great place for companies to invest there because of contract terms. Now, there's some enthusiasm with the new government in Argentina that you might get better contract terms, which will incentivize companies to go in there. But yeah, it's been a combination of not great geology in other places, land ownership, and not great contract terms that have prevented the growth globally. But I can tell you, when you go and talk to national oil companies in the Middle East, like in central banks, one of the scenarios they kind of fear as their Armageddon scenario is what happens if shale goes global, and it's not just a U.S. development. I mean, I heard a scenario pre-price collapse in one GCC country, central bank governor. He was worried in the spring of 2014. He said, yes, we're sitting above 100, but what if something happens, Iraq meets their expectations and shale becomes a global development? He said, at that point, we won't be able to control the price environment at all. I remember I was at a different investment bank, and maybe I was a little too arrogant because we didn't really understand the full development of shale. And I said, well, thus far it's a U.S. development. And right now the cost to produce shale, 60, 70 break-evens. We weren't thinking then about 30 or 40 break-evens. And I said, so we're not really worried about it becoming a global development. And that central bank governor said, weren't you the House that said that shale would only be a couple 100,000 barrels year on year, expensive to develop, high decline rates, and look what we're in of 1 million barrels a year coming out of the U.S. in terms of growth. So who's to say, he said, that China's not going to be able to deal with an infrastructure issue of all countries? Who's to say that they're not going to be able to eventually develop this resource in Europe? There won't be some breakthrough that facilitates that development. And maybe Argentina will get their act together. And he said, and what if Iraq manages to meet that ambitious target of 8.5 by 2035? He said, for you sitting at an investment bank, it's kind of an academic exercise. But for us, this is our national security. So I think that is also what does sort of scare them is, what if you did have this become a global development? For now, as I said, there are issues that have made it U.S. only, but things can always change.
Japan dependence?
Sorry?
Japan's dependence on Middle East?
Japan's dependence?
Heavily dependent on Middle East. I mean, Europe's a bit different because they're sourced Middle East and Russia. But, for Asia, it's been, it's a largely Middle East story.
Please.
Institute. My old friend lives in Buenos Aires. Don't wait for Argentina to get together. It seems to me there's one issue that hasn't been discussed here that's probably almost entirely beyond the reach of U.S. policy. And that is domestic consumption in some of the producing countries. Yes. You know this is a big issue in Saudi Arabia, but you can also imagine, let's say, an economically liberated Iran, a more rapidly developing Indonesia. You pick your own countries, consuming more and more of their own output. To what extent is that a medium to long-term factor?
I mean, one of my all-time favorite reports was the Chatham House report, Burning Oil to Keep Cool, the sort of hidden crisis of Saudi energy demand. And this is the big question in terms of ability to maintain high levels of exports is if your domestic consumption is growing at 6 to 7% per annum, and in the summers, your demand may swing 600,000 or 700,000 barrels because they need oil for power generation. I mean, there was that Chatham House report. Now, this was not necessarily should be our base case, but they warned that if Saudi didn't fix this problem, they'd be a net importer by 2040. And I think the Saudi government took that very seriously. They invited the author to come to the kingdom and talk about the report, which usually, if you say something critical, that may not always happen. So I think that sort of lit a fire. And I think that's why the Saudis are pushing ahead aggressively with gas projects like Wasset. I mean, when I talk about the rig counts in the GCC, a lot of that is for gas. I mean, they're very focused on developing gas assets, so you don't have to use so much crude for power generation. But will those improvements alone be enough if you don't deal with the subsidy issue? And I think this goes to the heart of a lot of the reforms being undertaken in the Middle East that I watch is how successful are they going to be in terms of the subsidy efforts? I mean, we saw the Saudis raise pump prices in January quite overnight. But as they go deeper into these reform efforts, are you going to start to get pushback from the population? We saw some pushback over the water utility price increase. We saw what happened, in countries like Kuwait. People don't like the idea of having the social welfare safety net touched. So I think it's going to be a very interesting challenge as these governments become a little more cash-strapped. How much can you ask the citizens to pay for their upkeep? I mean, it's cheaper to have subsidies when oil prices are low, but again, it's still going to be a problem in terms of how much they consume.
Just a quick comment on that. The Deputy Oil Minister of Saudi Arabia, Abdulaziz bin Salman, has been on this big kick to increase the efficiency with which energy is used in Saudi Arabia, and arguing that, look, it's going to be difficult for us to touch the subsidies, but it's going to be quite possible for us to persuade people to use air conditioners that only uses 1/3 as much electricity as they do at present. And I think that there's tremendous possibilities there for increasing efficiency, insulation, and so on. And I also think that really it is a question of how much oil is being burned to generate electricity. And every country in the region has got an ambitious program to end the use of oil for electricity. And that will transform things. Now, this has led to some rather interesting situations. The most recent electricity plant that was commissioned in Dubai, for instance, burns coal. And when the United States started its exports of liquefied natural gas recently, the first 2 cargoes, I believe, were sold to Dubai and Kuwait. But that does make economic sense, is not to use oil for generating electricity. And there's very, very few places besides the Middle East where, very isolated little markets like Hawaii, where oil is used for generating electricity. And I do think that that's going to get phased out over the next decade, and that'll make quite a difference in Saudi oil consumption.
Yeah.
We have another million cars on the road in Iran, let's just say.
Well, frankly, if you have another million cars on the road in Iran that are produced by Peugeot of good standard, oil consumption will drop because they won't have these dreadful paycons that with their current oil consumption standards. So the more rapidly people replace the existing car fleet in Iran with new car fleet, the more quickly oil consumption is going to drop.
Helima, I think this might be the time when I asked the question of the Saudi Arabia, where various comments have been coming out in recent weeks of the kingdom looking towards a post-oil future, which to many of us seems a contradiction in terms, an absurdity. Is it? Or is there, what is happening in Saudi Arabia?
Well, I mean, one of the things that everyone is really watching from an investor standpoint, like what gets people in my universe very excited is this Saudi Aramco IPO. I mean, when I go into client meetings, everyone is so excited about the potential, public listing of Saudi Aramco, given that the reserves dwarf Exxon. Like, what would this mean in terms of valuation? I mean, that's where I find myself having to sort of push back the enthusiasm. I think there is a difference, I would say, between the skepticism that you have sitting in Washington and sometimes the enthusiasm I encounter in New York and London, where people say, well, I used to work at McKinsey, and McKinsey's going to overhaul this, and I think it's going to be great. Whereas when I talk about the IPO, I'm like, well, there's some issues potentially about like where can you list in terms of transparency requirements? Can you really list on the NYSE or in London? We may have to list in an Asian market where you really put the upstream on offer. Whereas I think when you talk to people in Washington, you get more skepticism about the reform effort. Whereas I think investors right now, there's more of a willingness to say, well, this is going to work because it's the largest McKinsey contract globally, best and brightest. They'll be able to pull this whole thing off. And I guess maybe I'm a little more, take a nuanced view, because I also remember being at the Jet Economic Forum, right, when Abdullah became king, and the story then were the economic cities and the loud pumping music and the Amar developer talking about this was going to end Saudi Arabia's dependence on oil the first time. And so I think that we'll just have to see where they do in terms of reforms. But I think it's going to be, some of what they've talked about seems to me to be tremendously challenging in terms of getting the bureaucracy to carry forth the type of reforms. And again, I look mainly now at the IPO issue, and I think it's going to be probably scaled back from what is being talked about now eventually.
There was a question over here.
Doug Hengel with the German Marshall Fund, and a former State Department official who worked with Helima and others on energy security issues.
And at Princeton together.
And yes, at Princeton. I'm a little concerned that some of the comments here may lead to a false sense of security about where we are on oil. And I think we have to remember that the United States last year still imported about a quarter of the oil that we use on a net basis, and that's going to be higher this year because our production over this past year has fallen about 1 million barrels. In the meantime, the Middle East is producing over a third of the oil that's used in the world now, the highest level since 1975, and the longer that prices stay low, the more we're going to rely on the Middle East, because that's where the lowest cost oil is. So I think it's useful to have work out there to think about the Middle East.
and we look to be in an era of plentiful oil at the moment, but that can change very quickly. And so I think we can't forget about the Middle East as this place we have to worry most about in terms of our energy supply going forward, because oil is not going to be replaced overnight. So the markets look good now, but that can change.
Right. No, and that's why I think part of the reason why I look at Iraq is I say, like, that is North America alone, even if we get a rebound in terms of U.S. production, and if capital markets, which I think is very key, by the way, if capital markets remain open to U.S. producers and it's a snapback at some point, we still are going to need other projects to come on. I just singularly focus on Iraq because, again, no other country was supposed to supply as much new supply on the market as Iraq. Again, it was 40% over 2035 was the projected contribution of Iraq. And if Iraq underperforms, I do think it has important implications over the medium term. Also, again, who else is really growing outside? I mean, it took $100 barrel oil to have the U.S. grow, but nobody else was really growing at $100 barrel oil. And so I do think the challenges will come over the medium term. And I think that, again, even if U.S. production does come back, we still need these other producers to come on.
And by the way, a major focus of our study was simply to say, look, people, even if it weren't for the question of oil, we'd still have many reasons to be involved in the Middle East. The Middle East produces insecurity that makes it very important that we be involved there, whether or not there's we are dependent upon Middle East oil, whether or not the world economy is making that much use of Middle East oil. But you're absolutely right that the Middle East oil is going to remain a very important part of the world economy for a long time to come. And because the United States is going to remain in planet Earth, we are going to be affected by what happens to Middle Eastern oil and how it affects the world prices of oil, without a doubt. That said, I do think that there are a number of things which could happen that would, in fact, make the oil supply situation even more ample than they are at the moment. And so I remain entirely agnostic as to whether or not the price of oil, if we get together in 5 years, is going to be about where it is now, or it's going to be significantly higher or significantly lower. I don't know. But I do know that wherever it is, the United States is still going to have important security interests in the Middle East that will lead us to want to be very involved in the Middle East, no matter what happens to the price of oil.
And Patrick, if I could ask you at this point to give us some sort of assessment about whether sanctions on oil, such as there were on Iran, are effective, worth repeating in other places, or on the whole, a poor experience?
Well, I've written quite a lot about the sanctions on Iran in particular, but sanctions on other countries. The question whether or not sanctions work depends greatly on what you expect them to accomplish. We're referring to the Iraqi invasion of Kuwait 26 years ago, and remember about 4 days after the invasion, Judge Webster, the head of the CIA, convened a meeting and invited in a few people who've been following Iraqi oil, which at the time there were very few of us, and we had a session about whether or not the sanctions on Iraq were going to work. And what we all agreed upon was that if you want to inflict pain on Saddam, if you want to send a signal to Saddam that we really care about this matter and we're serious and we're thinking about doing something militarily, that you can expect to accomplish with these sanctions. If you think these sanctions are going to lead Saddam to pull out of Kuwait, good luck. Not likely. But you can accomplish certain things. Now, the sanctions on Iran, the Obama administration, and for that matter, the Bush administration before it, the major thing which the president wanted was to get Iran to come to the table to negotiate about their nuclear deal. Now, there are many in the bureaucracy and many outside the U.S. government who are convinced that the real goal of sanctions was something else, like bringing about regime change in Iran. But for both of those presidents of the United States, the goal was to get Iran back to the negotiating table. And that worked. So the objective that the president had in mind was accomplished. Now, whatever you think of the nuclear deal, that's a different matter. But the sanctions were certainly a factor in accomplishing the objective that the president looked to them for.
Do you have views on sanctions, Helima?
I think Patrick is.
Okay, fine. There was a question at the back first.
Herbert Regenbogen from Turo Law Center. I have a question concerning the energy security and the competitiveness in regards to United States involvement in putting an end to the kleptocracy, which is the underlying cause for seeking transparency and a stop to this organized corruption. And as the oil competitive market increases with the assumption that bribery is a part of this, isn't it in your view that this type of competitiveness will have even more aggressive impact on the market than what has been described until now?
Well, I would argue that a lot of energy security comes from having energy that comes from a wide variety of different sources, and that the energy which comes, for instance, oil, which comes from a large number of different countries, reduces our vulnerability to political developments in any one of those countries. And so that we should be, the United States government should be encouraging production from a wide array of countries. And in order to get that, it's important that there be a good business environment in these countries. And that even a functioning democracy like that in Brazil, if it has a poor business environment because of blatant corruption and energy nationalistic policies, is going to do very poorly at attracting investment and very poorly at expanding output. So that the U.S. has an interest in encouraging a good business environment in those countries and regular rules. The question of corruption, corruption hurts a good business environment. But let us recognize that if a government wishes to direct the benefits, the riches that are produced by oil output, primarily to a royal family, there's not much we can do about that. And that may be compatible with a good business environment. And as much as that's not the kind of society we would wish to live in, it may be one with which oil companies can work relatively well.
I would also say just, in terms of countries I've covered, like Nigeria, I think, again, like what's interesting is the opportunities potentially of a low oil price environment when you're not also as dependent on taking the resource from that country, you can become a little more, let's say, values-based in raising issues about corruption. Like I do think that the corruption of the Goodluck Jonathan government was a front and center issue of the U.S. government. I think they took a very tough line on corruption in a way we may not have taken a tougher line under Obasanjo, when oil was seen as not as abundant and we needed that oil. So I do think in certain instances, the lower price environment does enable more attention to governance issues. And in a country like Nigeria, the problem is when you have corruption, particularly when you have a situation where oil-producing states do not see the benefits of production, and you get armed militants, and then you have shut-ins of production, then that corruption at a high government level, particularly state governors, becomes an issue in terms of actual production. So in certain places, the kind of greasing of the wheels can make an environment that's relatively stable for a company to operate in. But in countries like Nigeria, that level of corruption really facilitates instability, which in turn causes production to be taken offline.
There was a question here, gentleman here.
Lou Pugliese, Energy Policy Research Foundation. Patrick and Simon, I really enjoyed the presentations. Just a couple points. I think I can make a strong case that the long-run price of oil is going to be closer to 50 than 100. Scott Sheffield, the CEO of Pioneer Resources, said he could probably see the Permian Basin expand 6 to 8 million barrels a day at $55 a barrel. I don't know if
That's
it's
a
true or
lot.
not. But second, yes, we've had a massive cut in capital expenditures, but we've also got a lot of inflation. So the real cut is much less. But what I'm sort of interested in, Patrick and Simon, is let's just assume we're going to have a long-run price closer to 50. What do you think it does to regional rivalries in the Gulf? Who is likely to emerge as a hegemonic power, or what? How will the Gulf producers sort this out in terms of their ability to pursue their own interests in the region?
Well, I think one of the reasons Mohammed bin Salman has been so hot on this idea of a post-oil Saudi Arabia is that he looks what's happened across the waters in Iran. And that for all that we make fun of Supreme Leader Ali Khamenei's talk about a resistance economy in Iran, the fact is that after decades of talking about it, over the last decade, Iran really has moved to diversify its economy. The Iranians were trumpeting their customs figures for their year, which ended on March 21st, and those figures showed that Iran's total imports were less than its non-crude exports. Now, that's cheating a bit because the non-crude exports includes condensates, okay, but still, the fact is that when you have $49 billion in imports and $42 billion in non-oil exports, setting aside the condensates, that should give you an indication that Iran's developing a real economy. I mean, Iran's a country that's exporting automobiles. It exports steel. Because the Iranian automobile industry is in crisis at the moment, not doing well, it's only producing 940,000 cars a year instead of the 1.4 million it could otherwise produce. But this is a real economy. I mean, it's not quite like the great transformation in Indonesia made. But if over the long term what we have is a low oil price environment, Iran gains. Whereas a place like Iraq, which is systematically undercut every agricultural production, industrial production, you name it, they've undercut it. So it's completely dependent upon oil. It loses. And that, I think, is part of the reason why Mohammed bin Salman is so hot on trying to see that Saudi Arabia really develops something. Because obviously in a low oil environment, also a place like Dubai wins. Right? It's not just Iran, but Iran is the big one.
We're coming to the end, so I will take the last two questions together. This gentleman here, and David, if you still had a question? Okay, you have the last question, sir.
Sure, and I'll ask a two-part question, if I may.
You are?
Karwan Zabari with the Kurdistan Regional Government, my apologies. The kingdom, going back to the OPEC, where the kingdom remains the driver and everybody else is a passenger, for how long can the Saudis afford to press on gas with respect to their economy and digging into the national reserves? And finally, did I understood you correctly that, Dr. Croft, that the oil market will remain saturated for the next 2 years, that after that 3 to 5 years, the demand will become higher?
Well, the issue in terms of the next year, we always say there was a two-step process to moving prices to 65, 70. And your question about the Pioneer, I would say Pioneer is one of the companies with the best balance sheet in the best acreage. So Pioneer is not, other companies operating in the Bakken and the Eagle Ford are much more stressed. They're not in Pioneer's position. But in order to get to that sort of 65, 70, first you needed to get rid of the overhang, the immediate supply and demand overhang, which at one point, was over 1 million barrels. We think we've kind of compressed that. We now have very, very high global inventories that need to be worked down. So we think that next year we still stay muted because we have to work off those inventories. Only when that happens do you get potentially on a more sustainable basis, 65, 70 without some disruptive event. But in terms of Saudi, and some of this will be Simon's expertise, they do still have ample FX reserves. Not what they used to be. They're not 734 billion like they were in the summer of 2014. They're down to about 560, but they can borrow. And so they have several years. If they just wanted to use their FX reserves, they could basically keep going. I think it's going to be a combination of some savings through reforms, increased borrowing, and still drawing down on FX reserves and trying to ride out this muted recovery. I don't think they want 100 again. I think they do not want to go back to a situation where you bring all this U.S. production back online. I think they're prepared to wait this out for a while. But what I thought was very different at least from an optics standpoint, about the last OPEC meeting was, the new Saudi energy minister took a much more conciliatory line with the rest of OPEC. I mean, basically went and visited delegations, essentially said, we all want higher prices, we all need higher prices, we sort of feel your pain, and we're in this together, which was a contrast, frankly, from December, where you had some GCC energy ministers saying, I regret nothing going into that meeting, and we're fine. So I think that the Saudis did a good job, frankly, this OPEC meeting, keeping poor countries in the tent. Like the fact that the Venezuelan oil minister was happy and essentially said, we're good, whereas in December, the Venezuelans were screaming. He also said there was no crisis in Venezuela, so I think couldn't really trust him on that. But I think they managed the situation, the optics of it, a lot better this time.
Can I just point out that we are, you believe it or not, in year 8 of global economic expansion. And they rarely last that long. And if we were to have a significant global economic downturn, we could see a drop in global oil demand that would be considerable. And that would affect the price.
Well, all it leaves me to do now is to say thank you very much. And in case you've forgotten, this is the publication we're trying to promote here today, Energizing Policy, America and the Middle East in an Era of Plentiful Oil, by my colleague Patrick Clawson and myself. I'm Simon Henderson. It's available on the Washington Institute website, washingtoninstitute.org. And our thanks also
physical copies
our
available.
Thanks also to Dr. Helima Croft for her participation here today as well. Thank you very much.
Physical copies are available outside. If you'd like to pick one up, please do.
Can I get one autographed?
Sure. Have two.